Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
All right, let's look at the tape immediately because the numbers we saw, close out the week on January 14th, 2026. They're just impossible to ignore. You had Nokia OJG gap up and close right near that 660 mark. But the price isn't even the headline here. It's the sheer conviction behind it. We saw volume exceed 40 million shares. And to put that in context, the average is sitting around, 24 million? That isn't retail traders, chasing a meme. That is a massive institutional footprint stepping in and staking a claim.
It's certainly a wake-up call, I'll give you that. And technically, it's textbook market structure. We just confirmed a golden cross this January. The 50-day moving average at 654 finally crossed above the 200-day at 644. So we are sitting right in a critical pivot zone around 661. But we have to ask, why now? I mean, the market is suddenly buying this AI supercycle narrative, effectively trying to divorce Nokia from the rest of the legacy telecom pack. The real question is, are they right to do so, or is this just a trap?
Precisely. And that brings us to the central question we're debating today. Is Nokia undergoing a fundamental metamorphosis into a critical enabler of AI-driven data centers, essentially becoming the nervous system of the AI revolution? Or is this just sophisticated AI washing on a legacy equipment provider that's been dead money for a decade?
See, I come at it from a different way. You see a metamorphosis. I see a fresh coat of paint on a very, very old building. I see a company that is still heavily tethered to the cyclical, capital-intensive, and frankly, low-growth mobile infrastructure business. The narrative is exciting, I get it, but the execution risks of pivoting a ship this size, especially with the Infinera acquisition looming, they're massive.
I see why you'd think that, but let me offer a different perspective. I'm arguing that Nokia is structurally re-rating. I mean, between the AI RAN shift, the validation from NVIDIA, and the Infinera deal, the risk-reward profile here is incredibly asymmetric. We are looking at a hardware provider trading at distressed multiples while moving into a sector with truly exponential demand.
Distressed multiples can often be a value trap. But okay, let's lay out the position statements clearly before we really start to dissect the specific catalysts.
Let's do it. So, my thesis is straightforward. Nokia is no longer just a cyclical telecom vendor. It is pivoting to become the plumbing for the AI economy. The market is drastically mispricing this transformation. Right now, Nokia trades at roughly 6.3 times EV to EBITDA. If you look at specialized networking peers, the companies Nokia is becoming more like, they're trading north of 18 times. The market has not priced in the shift from mobile connectivity to data center and edge computing.
But is that shift guaranteed? I mean, really?
Well, the evidence is there. Just look at the NVIDIA moment. We aren't just talking about some press release. In October 2025, NVIDIA made a $1 billion equity investment at $6.01 per share. That acts as a hard valuation floor. The premier architect of the AI revolution essentially said, at $6, this technology stack is undervalued. And you combine that with the macro tailwinds. The Fed has cut rates to between 3.5 and 3.75%, and you're seeing deferred CapEx budgets finally starting to unlock.
That is a compelling argument. But have you considered the reality of their revenue mix? My thesis is that while the AI narrative is attractive, Nokia is still tethered to that mature, slow-growth mobile infrastructure segment. You can't just wish that part of the business away. A significant portion of their revenue still comes from traditional communication service providers, or CSPs. And that sector, it's not growing at AI speeds. It's barely growing at all.
We can't ignore the legacy, sure, but...
And then there's the execution risk. They're closing the Infinera acquisition next month. I mean, large cross-border acquisitions are notoriously difficult to integrate. Merging sales teams, merging product lines, it rarely goes as smoothly as the PowerPoint deck suggests. My concern is that this is a value trap. The low valuation you cite might just be the conglomerate discount applied to a company with, frankly, internal friction between a high-growth unit and a stagnation unit.
I think that frames the tension perfectly. So let's dive into the core debate, starting with that NVIDIA partnership and the AI RAN paradigm.
Please do, because I think AI RAN is becoming a buzzword. What does it actually mean for the bottom line?
It's a complete technological shift. Historically, radio access networks, the stuff that connects your phone to the tower, it all relied on proprietary single-purpose hardware. You bought a box, it did one thing. AI RAN changes all that. It runs on general-purpose, accelerated computing platforms. Specifically, Nokia is integrating their AnyRAN software with NVIDIA's Grace Hopper superchips.
But moving to general-purpose hardware, doesn't that usually compress margins? If everyone is just using NVIDIA chips, where is Nokia's moat?
The moat is the software and the integration, but the opportunity, that's the customer base. This is the key insight. By putting compute at the edge, the base station isn't just a passive relay anymore, it's an active node of compute. This appeals directly to hyperscalers like AWS, Azure, and Google, and the new AI cloud providers like CoreWeave. These are not telcos with flat budgets. These are companies where CapEx is growing north of 15% annually. Nokia is moving out of the stagnant pond of telco spending and into the raging river of AI infrastructure.
I am sorry, but I just don't buy that it's that simple. You're talking about a new paradigm, but adoption takes time. Telcos are notoriously slow to upgrade architecture. And regarding the hyperscalers, Amazon and Google are ruthless. Can Nokia truly compete with established data center players just because they have a partnership with NVIDIA?
The NVIDIA investment at 601 suggests they can. NVIDIA doesn't throw $1 billion at a legacy vendor out of charity. They need the infrastructure to work. They need the last mile of the AI network to be efficient or their own chips bottleneck. They picked Nokia to solve that problem.
An investment is a signal, yes. But let's look at the rest of the business. You have this value over volume strategy in the mobile segment. That's just corporate speak for managed decline, right? They are trying to squeeze cash flow out of a shrinking business to fund the new one. If the mobile segment shrinks faster than the AI segment grows, the stock goes nowhere.
That's assuming mobile is shrinking rather than just stabilizing. But let's pivot to the engine that is actually growing, the Infinera acquisition. This deal closes on February 28, 2026. It is a game changer.
$2.3 billion is a big bet.
It is, but look at what they get. They gain vertical integration with indium phosphide photonic integrated circuits. In the AI era, optics are the new bottleneck. You can have all the GPUs you want, but if you can't connect them with low latency, you just have a traffic jam. Infinera gives them that core tech. More importantly, Infinera has 30% revenue exposure to the North American web-scale market, the big four hyperscalers.
So they are buying access.
They are buying accredited access. It accelerates their entry into that market by years. And the financials back this up. Look at Q3 2025. Optical networks surged 19%. That is the smoking gun of AI demand. It's real revenue, right now. They beat EPS consensus by 21%, 6 cents versus the expected 5.
I admit the optical growth is impressive, but I worry about the digestive phase of this acquisition. You're merging a U.S. company with a Finnish company. The cultural differences alone are a risk factor. And if you look at the margins in Q3 2025, gross margins, they compress slightly to 44.2%.
That was regional mix, more business in India.
Which is a lower margin market. That's my point. Until they prove they can integrate Infinera and actually get those synergies, the acquisition just adds complexity. And investors hate complexity.
Investors hate complexity until it prints cash. But let's talk about how the market is valuing this complexity. The comparison with Ericsson is stark.
Ericsson is the clear comparison.
But the correlation has broken. Over the last year, Nokia is up 31%, while Ericsson is up 23%. The market is starting to decouple them. Ericsson is a pure mobile play. That's massive concentration risk. If 5G slows, they have nowhere else to hide. Nokia has the diversified network infrastructure growth engine.
But Ericsson is a simpler story. We do mobile. And simplification often commands a premium because it's easier to model.
But look at Ciena. Ciena is the closest peer to Nokia's optical business. Ciena gained 187% in the 6 months leading up to January. If you valued Nokia's optical business at CNS multiples, that division alone would rival Nokia's entire current market cap.
That's the sum of the parts argument.
Exactly. It implies the mobile business is currently valued at 0 or even negative. That is just irrational. And compared to Cisco, Cisco trades at 18.7 times EBITDA. Nokia's at 6.3. Yet Nokia's enterprise segment is growing double digits. That gap is nonsensical.
Well, Cisco has a massive software moat and recurring revenue that Nokia doesn't have yet. You pay a premium for software. Nokia is still largely perceived as a hardware box shifter. That perception takes years to change.
The perception is lagging the reality. But let's look at the market mechanics, because the smart money is already positioning for this re-rating. I want to talk about the dark pools.
Okay, this is where it gets interesting.
On January 13th and 14th, off-exchange short volume was around 52%. Now, retail investors often misinterpret this as bearish. But in market microstructure, market makers short to facilitate institutional buy orders. They sell to the institution and then go buy in the lit market.
Right. High short volume with a rising price is usually accumulation.
Exactly. We are seeing dark pool net flow accumulation right at the 650 to 660 level. That is a line in the sand. Institutions are defending that price, and look who is buying. Thrivent Financial initiated a 12.6 million share position. Thrivent is a long-term value shop. They aren't day trading.
I'll grant you the institutional interest is rising, but let's look at the lit short interest. It's less than 1% of the flow.
Which is bullish.
It's bullish in the sense that there are no sellers left, sure. But it also means there is no short squeeze fuel. If this stock goes up, it has to be on genuine organic demand. You aren't going to get a violent 20% spike because hedge funds are forced to cover.
I'd argue organic buying is healthier, and the options market supports that view. The put-call ratio is 0.06. That is absurdly bullish. For every put, there are 16 calls being traded. The volatility skew favors out-of-the-money calls. Traders are paying a premium for upside exposure.
However, implied volatility is elevated at around 43%. The market is expecting turbulence. Maybe it's the earnings coming up on January 30th or the merger closing. It's not going to be a smooth ride up.
Volatility creates opportunity. But I want to bring in something that I think signals where we are really going. The sentiment arbitrage visible on Polymarket.
You know, I'm skeptical of prediction markets as a stock indicator.
Hear me out. It's about information asymmetry. Prediction markets often lead equities because the participants are different. Engineers, developers, crypto natives. They see tech adoption before Wall Street analysts do.
But there is no Nokia contract on Polymarket.
No, but look at the proxies. Contracts for global AI compute capacity 2026 are trending heavily yes. The crowd is betting the house on an AI supercycle. So here's the arbitrage. The prediction market says AI compute is exploding. To have that compute, you need optical pipes. Yet Nokia is priced like a legacy telco. If the crowd is right about the compute, the infrastructure must re-rate.
That is a correlation, not causation. Just because compute grows doesn't mean Nokia wins the contract. It could be Ciena, it could be Huawei in other markets.
In Western markets, it's not going to be Huawei.
Fair point. But I think the equity market might be right to be cautious. The real money on Wall Street moves slower than the Polymarket crowd for a reason, due diligence. They are waiting to see if that compute demand actually translates to Nokia's bottom line, or if it just bypasses them.
I'm not convinced by that line of reasoning because the backlog is already showing it. But let's wrap this up. We are at a pivotal moment.
We certainly are.
Okay, I'll give my closing thoughts first. The bull case target is 950 plus. Nokia is building the railroads for the AI era. You have a technical breakout confirmed by volume. You have a valuation floor set by NVIDIA at 601. You have a growth engine in Infinera about to come online. This is a rare value growth hybrid. The window to buy a critical AI infrastructure asset at single-digit EBITDA multiples is closing as the Rust Belt perception fades away.
And I will urge caution. My base case is $8, but my bear case is back down at $5.40. While the potential is there, we cannot ignore the culture war risk between the two operating segments. Integration is hard, and if we hit a macro recession, or if hyperscalers decide to cut CapEx even slightly, this entire thesis collapses back to historical support levels. The stock has had a great run, but the heavy lifting of execution hasn't even started yet.
And that is the nature of the debate. The stock is sitting at a critical value realization point.
It is up to the listener to decide if this is a genuine transformation or just a very good narrative.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.